Hey guys, Freaky Finance here. Yesterday, we just did a year cap and review, and if you saw my list of 40 companies that I put on there that I hold, First Capital REIT is one of them. So I figured I'd talk about that one today since it's fresh in my head and I didn't want to dive into something new right after New Year's. So First Capital REIT is interesting for a number of reasons, and we'll go through it. But you can see all the properties are in Canada. And this company specifically targets high density neighborhoods, so a lot of people close together, and it also targets places that have higher income. So basically, you're targeting the upper areas of each major city. In this case, you're targeting Vancouver, Edmonton, Calgary, and then heavily in Toronto and Ontario in general, and then Montreal. You can see this is just the numbers of properties. Let's just say we dive into GTA area, and you can see that they have quite a lot of their properties scattered in the high dense areas. And how this breaks out is you can see the minimum rent, very much Toronto driven, 48% of the portfolio value as of September 30th, 2020, so the latest quarter. And Montreal and Calgary are tied for second, and then you got Vancouver and Edmonton, and then the remaining ones in Ottawa and Ontario. Geographically, it's not super diversified because the strategy is going urban, and one of the reasons why I like it is because, well, it's still down almost 35% year to date, so I'm getting quite a discount to what it used to be priced at, even though the property value may not actually be getting marked down like that. One of the things you got to remember that Toronto and Vancouver in Canada have been fairly heated markets, right, relative to the rest of Canada anyway, and so overall, not super geographically diversified, but the strategy is to go urban and go where people are. And a part of that also drives the rent per square foot. I do want to point out here just an example of one of the properties. So this is one on their portfolio, but you should on that map just go through some of them and just be like, okay, this is what this building, they own this building. So you can see here they're targeting places that have a lot of foot traffic. So during COVID, obviously, that's a bad strategy, right? You pretty much got killed on the timing of that, because people are trying to literally be socially distant. However, once we come out of COVID, this company is going to be looking pretty good. And, well, that's the thinking anyway. I mean, it won't all flock back, but I think there's going to be quite a resurgence of people trying to connect with each other. And these places are ideally located for that. Much more importantly, you can see here, I'll blow it up for you guys. You can see the rent per square foot. As of September 30th. So more importantly, you can see here the rent per square foot per area versus what it was 9 months ago. So pre-COVID numbers versus 9 months into COVID. While the media focuses on rents might be plummeting, blah, 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 you have to remember what they're plummeting against, what their benchmark is, right? Are they plummeting versus last year, or are they plummeting versus what they were 5 years ago? Because these leases for these businesses that we'll talk about, the tenants of First Capital, have an average lease life of 5 years, right? So the rent reset cycle is different from an annual rent reset cycle that most people who are renting their homes, mortgages, or renting their apartments would be thinking about. So you can see here that rent's actually gone up versus 9 months ago in almost every single one. And that's a good thing from our point of view, obviously. It also means that they're locking in at higher prices. The average per square foot, $21.84 versus $21.25. You can also see that they shed 6 neighborhoods. That's how they're categorizing their targeting. They're allocating capital to specific neighborhoods. It's kind of I like the strategy actually. They're trying to build a whole community instead of just invest in a standalone building. And it does look good, right? We want a daycare here, and then they'll put a daycare there for everybody, right? And it ties into the other businesses around it. And they attracted some pretty good businesses for restaurants. Obviously, the mom and dads that attract people in that are unique have suffered, right? So they're also keeping them afloat. And we'll talk about that in a bit, how this company has kind of tackled the pandemic a little bit differently than others. And then overall on the sheet, you can also see the occupancy is slightly down. So you can see GTA is down 0.8%, but not a material amount. And Vancouver's down 3%. So their tenant mix is pretty strong. And so I remember we went through Slate Grocery REIT, which had a 35% or maybe 40% exposure to groceries. So this one has 17% of the rent to groceries. And it also has, during COVID, they changed the presentation, this tenant slide. They kind of broke out certain things. They put necessity-based retailers at the top. So I thought that was kind of interesting, just for context. But you can see they got the entire Walmart. QSRs, so originally on their presentation, they had QSRs and other restaurants together. They broke them apart because I'm sure investors are asking this company, how much of your exposure is actually restaurants? Is it 14%? How much is QSRs? So they broke out because QSRs are doing well, whereas restaurants are not. And you can see these restaurants, most of you, unless you're familiar probably with the area that they're in, you might not know, right? These are pretty unique restaurants. That's part of their strategy. But you got to remember that the restaurants that are shut are only 2% of their revenue. So it's not a part of the overall investment thesis. Well, it is in the long run, but for the short term with COVID, it's not. And we're going to see that when we go through the numbers. So pharmacy's 9%, another stable. Tenants is kind of a catch-all. You have a whole bunch of different people in here. Chapters, Indigo, Sleep Country's doing okay. Banks 8%. Fitness facilities obviously suffering. But again, it's only 3.6% of the rent. So if we add up fitness facilities and other restaurants, they're only at 5% of the rent. So overall, fairly strong and diversified tenant base. Another way to look at that, just the top 20 tenants. You can see 10% of the rent is Loblaws, 5% Sobeys. So the biggest concentration risk is in grocery stores, which are performing well and will continue to perform well. You can see it's loaded with the main banks, main Canadian groceries, pharmacies, Ontario Liquor Board. So yeah, overall fairly diversified, and that represents 45% of the revenue. 2% is Good Life, so that's your weakest link on this page for COVID. Alright, so we're in the numbers now. This is annual, so this is pre-COVID. And you can see revenues grew slightly, more importantly on less properties. So down here you can see they were already shredding properties, or this might be neighborhoods rather. They're already shredding it, focusing their resources on certain areas. And it also served to increase the rent per square foot, I'm sure. So you can see, however, rental revenue increased, operating expenses also increased. GMD really stable. I mean, up to $6 million, not material on the year. Though it's steady, which is what you want in a REIT. Corporate expenses slightly up, interest expense slightly up. I should say debt has been increasing. They are focusing on the strategy of going into the higher urban areas, but importantly, it's still below 50% of assets. Most REITs will have a covenant where you have to say be below 65% debt to assets. So this company is far below that covenant. That's standard with almost all REITs. So it's good to see this one under 50%. Just adds an extra margin of safety. They could always borrow against their buildings if they need to. And the noise on the REITs, we talked about this before. This is the biggest line that you'll see on REITs is mark-to-market properties. So during 2018, 2019, like I said, they have exposure to Toronto and Vancouver. Both markets have been performing well. So you can see they had a $100 million gain in 2018 and 61 million gain in 2019. They are material swings, and that will come into maybe why the investment's underperforming currently. Again, I view that as noise unless it's permanent declines, but usually property values over a long enough time horizon continue to increase, especially if we're still viewing reflation as the likely outcome, which so far has been true. Share price, actually during 2019, share price appreciated quite a bit on technically what I view really not that much difference. So from that point of view, it got slightly more expensive in 2019. I do want to point out, you'll see the fully diluted unit count decrease. So they sold properties and they used some of the proceeds to buy back their unit count. So tangible assets is pretty strong. So they got $10 billion in tangible assets. Accounts receivable, I just like to look at that for context for COVID. So I broke that out just to see what it was averaging before COVID. So I'm averaging around 34 million. Total indebtedness has ticked up, and again, you saw that in the higher interest expense. But overall, 4.7 billion versus the 10 billion in assets, you got a lot of asset coverage there. So from a liquidity or more, I guess, solvency standpoint, you're pretty good. And they do have a lot. We'll talk about that at the very end. But they have a lot of unencumbered assets as well that they could borrow against if they need to. So overall, fairly strong. Balance sheet, actually very strong. The CFO, again, largely steady. You can see it actually decline, and there's working capital adjustments there as well. However, FFO, which is more important, you can see it actually decline as well. Again, that's on less properties. However, you notice the revenue is higher, so that means overall the operation expenses outscaled the revenue. Which is never good. At the same time, the share price increased. So technically 2019 versus 2018, 2019 looks worse from my point of view. And so we see that here in the market cap for FFO, the market cap for AFFO, more expensive in those terms. Occupancy was just under 97% at the end of 2019. More importantly, and this is the trend that I like, is this. So rent increased 5% year over year. And that shows exactly what they're doing, or what they're saying they're doing. They're executing on it. They're targeting certain areas so they can get the most rent. And you can see that here. They shed some more properties, like we already talked about, and that trend has continued. So Q3, so this is September 30th numbers for 2020. COVID has had an effect and continues to have an effect. I do want to point out, and I'll talk about this at the end, that they do have the CECRA instead of CERS. So CERS came online October. This is the July, August, September period. So you can see what, and I'll talk about CECRA at the very end, but basically landlords abated 25%, gave up 25% of the rent. So they were only going to collect 75% of the rent. So what would happen would the tenant would pay 25%, government of Canada would pay 50%, and the landlord would eat 25%. And what eating looks like is you have to write it off or you just don't collect it. So some of this CECRA resulting abatement is flagged as bad debt expense, and that's buried in this operating income number. So there's noise from government programs in here. And one of the reasons I'm looking at it is I believe CERS, I think that's superior both from a tenant and from a landlord standpoint. And for this context of this video, it's good from a landlord standpoint. And more importantly, it'll be good for both that relationship after COVID, where CECRA, I think, had grounds for a lot of frustration. And CERS also allowed the tenant to actually qualify itself, because there was some data pointing out that the landlord wasn't going to register the tenant for CECRA, which was because they didn't want to eat 25% of the rent, right? Ultimately, if both are winning, someone could be losing. In this case, it's the government, because they're forking the difference. So they're the ones who are making the landlord more whole than they were under CECRA. And we'll see that. Well, we don't see the numbers yet, but that's what I'm thinking for Q4 and this 2021 year. These numbers are going to be better for First Capital, or at least that's part of the investment thesis. So GMD, you can see 115 million versus 101, so down 14 million. Better than Q2 was, but that's a low benchmark. But it does show that we're starting to bounce back, even though the share price has kind of lagged and actually gone back down again. This is why I'm looking at it again. And I should say I own it. So here, I kind of showed you this yesterday on the New Year's year in review. You can see I own it. I'm currently down 8 cents, so 1 day trading. And again, I think in a 6.3% yield, which doesn't sound like too much, but it's fairly strong in a low interest rate environment. And you got to remember, this thing is down 35%, so I'm not technically playing this just for a dividend yield. I'm expecting, or the thesis is, capital appreciation. So here, you might say, oh, it's only down 14 million. The share price is down 1.8 billion, 35%. Oh, that seems like an overreaction. You can see here, one of the reasons I think for the noise is the fair value market properties. So you can see in Q3 2019, marked up properties by 26 million, but in Q3 2020, they marked down properties 40 million. So that's a swing of 65 million, and you can see that difference in net income is almost 65 million. So it's a large part of the reason why there's swing. Obviously, the income tax is also not a big part of it. Overall, you can see the share price slid from $22 to $13.55 now. This company is now only worth $3 billion in equity, and they still own their $10 billion in assets, which they've written about $200 million down during COVID. And their accounts receivable has increased, so that's something that I always watch. But it's only increased $8 million, so it's not enough to really care, but it's enough to comment on. So you can see that it's up a bit, and usually when AR gets lagged, there's more chance for more bad debt write-downs. So what that means, they recognize the revenue, and then they're like, oh, it's just aging and not being collected, and then you have to test it for impairment. And they'll probably get some of that in their AFTA. They might increase the allowance for it, and that also hits bad debt expense as well. So anyway, CFO, a lot of work in capital swings. FFO, you can see down, mainly the GMD decrease of 14 million, and then some. Unit distributions, so fairly steady. You can see the unit distributions are still covered by the FFO, even at these reduced rental revenue levels. So that's good. So they're still able to cover their unit disposition at that 6.3% yield we just saw. They're still able to cover that. And then again, another way to mimic that is just your FFO payout ratio. Just another way to illustrate that. You can see that it's gone up because cash flow's gone down. they're still able to cover it. FFO per unit, bad, so you saw that decline. Part of that COVID effect, well, most of it COVID effect, and then the CECRA forcing the landlord to eat 25% of the rent regardless. Well, it does affect the numbers. More importantly, though, is this. So market cap divided by the FFO, so even though it's reduced, you're still getting a deal on the FFO, right? And I think a part of the thinking there is that this company, people aren't looking at it because it has the urban exposure that everyone, and the narrative the media is still pumping out is everyone's still leaving downtown. I think, well, if people were leaving downtown, eventually we're going to go back. There was a reason why people were living downtown in the first place. And while it might not be immediate, I think you have these leases in place and people, not everyone moved from downtown Toronto or downtown Vancouver. So I still view this as short-term noise, and one of the reasons why the opportunity is presenting itself to me. Number of properties, I already touched on this enough times already. You can see it continues to go down. Occupancy did go down, but 0.7%, so relative to other companies, occupancy is still pretty high. NAV per share, so that did go down. You can see the discount is widened quite a lot. So NAV went down, they were writing down properties, right? Because COVID does have an effect on property value in certain areas, especially. And you can see NAV went down $22. So even if the company wasn't conservative enough, you're getting a huge margin of safety. And its share price at $13.50 and NAV per share is at over 22. So I mean, I don't expect it to jump to 22 tomorrow. Like this thing, like I'm surprised it's not trading closer to 16 or 19, right? So anyway, that's just my thoughts. And then you can see the average rent per square foot we talked about is up about $1.19 versus where it was just a year ago. And that's been a trend for some time now. And that's what I think the company's been focused on. And that might sound a little bit convoluting. You're like, well, I thought rent was going down. You're over here. How is this one going up? Again, it's the rent lag cycle, right? Because they have 5-year lease terms. So you got to compare what's the rent today versus what the rent was when they locked in the lease 5 years ago. And another thing that's affecting this is that it looks like they're selling down properties that have lower average rent per square foot and focusing on certain neighborhoods that have highest average per square foot, highest density. During the third quarter, on the MDMA, you can see here to date they've already collected 90% of their rent for October, which is in line with what they did in Q3, and that's before the CERS. So the people that haven't paid rent that were forced to shut down, CERS, if they're forced to shut down, the government in Canada will pay 90% of the rent to the tenant, who then pays it to the landlord. So it's a more efficient cycle. The tenant qualifies it for themselves, and then they just give the money or not, whatever they owe to the landlord. But it's far superior from the landlord perspective than CECRA was, in my view. What else is there? During the quarter and during the year, you can see that they're still getting access to capital. And here they word this pretty well. First Capital funded a 10-year, $116 million mortgage, small in their context, 2.72%. Percent's lower than their WACC is, so it's lower than their existing debt on average. And it's the lowest 10-year rate the trust has ever achieved. So that's pretty good. It tells you kind of their risk profile. And one of the things that I don't think people are thinking of is that they're able to get rent that's cheap, and that lowers the interest expense, right? So it makes, and they're still able to get higher rent, so they're just making more money over time. And I think lower interest rates for longer will be good for this company, and they can still focus on the short end of the yield curve, right? They borrow at the short end of the yield curve, and they're still going to make money for the appreciation of property values over time. So it's a very interesting dynamic. I expect this cheap financing to those that can continue to get cheap financing to continue. And that will continue to enhance the income statements and earnings, and therefore distributions of these companies over time. That's something I don't think a lot of people are thinking of, because it's not immediate. It happens slowly, and then all of a sudden you're like, whoa, they're borrowing so cheap. Why is their R so low, or the discount rate, sorry, why is that so low? And the same thing could be said for some utilities we'll talk about, in the telcos, and really any strong company with a strong balance sheet. They're getting really cheap debt. Cheaper than I would get. What else? So I'm going pretty quick here. We've kind of already talked about their metrics over time. So this is just every quarter you can see. And I am expecting this to pick up with CERS versus CECRA. And then you're also just expecting this to pick up with general normalization trend over time, right? I kind of view it as a 35% discounted way to play or get exposure to Toronto and Vancouver downtown cores during a period of time where everyone's afraid, or where media is like, oh my god, downtown is horrible. Well, might be horrible now, but it won't be in the future, or at least that's the thinking. You can see just another way to show it. We've talked about the balance sheet. We talked about how they just borrowed at under 3%, 2.72. Well, their WACC is on their fixed rate debt is only 4%, so they're able to get access to debt at a cheaper rate than what they're able to get pre-COVID, even though technically their numbers are worse during COVID, obviously, right? So it's an interesting time to be a lender. And you can see they have $7 billion in unencumbered assets, so they could always borrow and use the building as collateral. That adds to the certainty of the investment thesis in the long run. If I'm wrong, it's not like this thing's going to go illiquid and solve it. They can just borrow on this, and we know that they can borrow at 2.72%. So CERS, just to, because I talked about this a lot, and it is part of the reason why I'm buying it, why I own it today. You can see here revenue dropped to 70% or more, and then if they're forced to shut down, so say like your Good Life's or your key restaurants during the second wave of COVID that we've had, this is one of the reasons why I think the company share price has fallen again. You can see the maximum sub rate 65%, but if they force the shutdown, they'll tick it up to 90%. 90% of the rent goes to the tenant and then flows to the landlord. And then, well, the landlord already was collecting 90% anyway. Well, that's what October told me. So it's almost like this CERS helps mitigate the worst case scenario. So it makes the investment, from my point of view, less risky in the worst case scenario, and then I still have the upside once they're past COVID. I like this scaling a lot better than just saying tenant pays 25%, and I think this will also help the landlord more, especially for the ones that are forced to shut down, right? Because technically the ones that are forced to shut down will only have to pay 10%, which still sucks. They're still paying 10% and they have no business. But under CECRA, they are forced to pay 25%, right? So for some tenants, this will probably be worse. For some, better. But for the landlord, CERS, I think, is far superior. And that's important coming out of COVID too, right? You're going to have all these contracts with leases being like, well, you said you'd pay this. What happened? Well, COVID happened. And so that's why you're going to have a lot of frustration, where I think CERS is going to be better served for both parties. And then CECRA, just for context, we talked about the 25% rent abatement, and that's what it was before. So we'll see what Q4 has in store for us on the collection front. Expecting less bad debt expense, but you never know with the second wave and how it affected the numbers. But I mean, if we're not playing this just for Q1 this year, Q4 2020, we're playing it for the next normalization period, right? So anyway, it's a different kind of REIT. It's not just a grocery REIT that we talked about, or HR REIT, which was the office play, as a diversified set of tenants and specific geographical concentration centers in Canada. So anyway, I'd like to know your thoughts on it, and have a great weekend.